to talk about.
So we'll just go over the three pensions,
Okay.
Yeah.
pension applications.
All right. So hello, everyone. Thank you. So we have three applications before you this evening. The first is Mark Campanello. He worked with the city with DPW. He was a class 1 mechanic.
He's getting before the pension again. I'm sorry.
Yeah, okay, let me pull that again.
You could keep going.
I'm so sorry. I apologize. I thought someone was either asking me a question or, so he has 20 years of service. He's requesting a standard disability pension with a commencement date of March 1st of 2025. We have Brenda Ray, who worked with the Board of Education as a nurse. She had 9 years of service. She had the type of pension is a vested benefit. She's selected the standard option with a commencement date of June 1 of 2024. And just as a quick note, the reason for that was that apparently we had the paperwork in the office had been received. So while we normally backdate them, this one we should have, because this one should have been processed quite a while ago. So just as a note for that, that's why it's a June 1 of 2024 commencement date. And then Richard Darling, who worked with the city in the finance department. He was the director of management and budgets. He was with the city for 14 years. He's selected a vested benefit, option 3, and the commencement date would be January 1st, 2025.
Okay, I have a letter from Social Security here. I'm sure you got the letter also, right? Do you have it available? But it does say here, it says, what we will pay is $3,008. But you, and
But that's Social Security pay, that's independent from what we pay.
So we do the difference, we pay the difference, or we pay on top of that?
No, we pay on top of that.
We pay on top of that.
Yes,
so he'll get $6,000 a
Yes.
month?
yes,
Yeah, so security and pension, right?
yeah.
Right.
Two different things, yeah.
The
Sorry.
So, okay, so is there a motion to accept Mark Campanello's,
So moved.
Second,
all in favor?
Aye.
Just out of curiosity, we already approved the prior payment, right? So what are we approving now?
Well, we're approving to change it to a disability rather than a regular pension.
So, and that's the adjustment then,
That's correct.
The 5-year,
Yeah.
that's the only difference.
Yep.
And he
it's
has to get that
slightly-
because of the fact that he's getting
slightly more.
disability already? Because in some ways, they're almost independent, aren't they? Or no, they're not independent?
Well, for our policy in the pension board is you don't get a disability pension unless you get one from Social Security.
Yeah,
And so this is what's triggering this.
okay,
They can't, even if they are, let's say, by their doctor, they've been disabled from work and unable to work anymore. We are unable to come to the pension board to request a disability pension until we have that designation from Social Security.
The reason for that was if we didn't want to get into a situation where
Yep.
your doctor says one thing and our doctor says another thing, so we've always gone by the idea that if Social Security says you're disabled, then we accept that. If Social Security doesn't, we accept that that statement too. One of the things on the Brenda Ray, Charlie felt that, she lists a son with no percentage given and a granddaughter with 50% listed,
mhm. I saw that.
right? So. Yeah, so we don't know who the beneficiaries are and what the percentages would be entitled. So it might be a minor thing, but we've always tried to make sure that everything is pretty clear and clean when we approve a pension.
On that form though, it's kind of funny, because on that form, it doesn't have a percentage for the primary.
Right.
So I almost, when I read that, I figured that was just if you deduce the primary.
Right.
Based on the secondary that you said, the second one, where you said 50%, must be 50 and 50 then.
Right, but it should maybe say
50/50.
50/50.
Yeah, probably should.
I mean, that's just a technicality, but
The form's not clear, that's for sure.
the form's not clear.
We can reach out to have her designate that percentage for the primary to clear it up and have her initial it, and I can bring it back before you for clarification if you'd like.
We can just see it again.
Do you want to
I mean, if it's. We can approve it subject to that line being completed.
Yeah.
approve that even with that?
Yeah.
All right, so so we would say pending that it being 50%. And if we would be, that would just be confirmed back to the board at the next meeting?
Yes, I will take care of that.
Okay, so would it be a motion to accept the Brenda Ray?
I'm most accept it.
Oh,
Second, all
I'll
in
second
favor?
that.
Perfect. If you want to read the Richard Darling, but I do have some comments for it.
I'm sorry?
The Richard Darling, one of the things is one place he's, and I did notice this myself, is that he was seeking benefits beginning on January 1st, 2025. But the attached documents seem to ask for benefits beginning in July of 24.
So,
So it's confusing to me and to Charlie both.
yeah, so there was a letter that was submitted by the applicant. So he reached out to the department in November of 2024, requesting documentation. Typically, it has been our practice to start the pension benefit the month after we receive all the documents. He would have been eligible to receive his pension as of July of 2024, but did not reach out to the department. There was a conversation with the involved corporation counsel and the mayor, alleging that it was the city's responsibility to reach out to all pension retirees or vested, indicating that once they were at the, eligibility age, that it was the onus was on our office to reach out. I disagree with that. I think that the pension document is up to interpretation. And so we are requesting a January 1 date. He is requesting that it be retroactive to July 1 of 2024, which would have been when he would have been eligible to start to receive the pension. He admits in all communications that he did not reach out to the city at all, and it was only in November. It was November 18th that he first reached out to the city, but is seeking the benefit to be retroactive. Honestly, and also I worry about the slippery slope that opens for my office, in that the obligation to track down, people who no longer work for the city, who are not retiring from the city, who are, who leave with a vested pension benefit, but are not eligible to receive that, is a burden that I'm concerned about taking on. However, we wanted to bring it to the board because if that is the way in which you want us to proceed, we will amend some of our practices. And when, people leave the city, you're going to ask for certain information, so we'll be able to, at least make a valiant effort to track them down.
And this one, maybe we'll go to executive session. It's been suggested.
Okay.
Yeah, Tina, now you can hear us, right? And perhaps maybe just only for the record, just to briefly state the pension, and then we consider it to be after some discussion, we voted to table. Is that reasonable?
Yeah.
Yeah.
Just so, okay, so if you just mention it, and then we will have that other motion, please.
So we're discussing the pension application of Richard Darling, who worked with the city in the finance office, the director of management and budgets. He was with the city for 14 years. He has a vested benefit and he had selected option 3. The question we are grappling with is the commencement date. And so
I
we
move
US.
uh,
Oh, I'm sorry, go ahead.
I move to table the
Approval.
the approval of the pension pending clarification from the city's council on the appropriate start date of the pension.
I'll second that motion.
Any discussion? All in favor?
Aye.
Opposed? Excellent. Thank you.
Thank you.
Next is gonna be Walter Scott.
Alan is on, I'll grab more.
Which means you need money from both the regular and.
Just the regular the pension fund. 9 million.
You say that like 9 million.
9 million.
Right, the singular sheets I hand out there have our,
Yeah.
we'll go through it a little later. Alan, are you still with us?
Yes, I am.
Okay,
Hello.
We're just grabbing Laura out of the hallway, so give us a second, but.
Sure.
Thank
Thank you.
Patience.
No problem.
You know what?
Sure, thank you. Hi, good evening, everyone.
Hello.
Hi, Tiffany.
Hi.
Nice to see you. Hi, Alan.
Hello.
So I think I
I
was.
think most of us want.
Hi, okay, you would like one?
I personally.
You can share a couple, there you go, okay. And you would like one as well? Anyone else? I have both large and small, okay? You're drinking off the small one, okay, you have your glasses with you, you might need them. right? So, and I guess I'm gonna be.
You can have it.
You know, I think. I have another.
Yeah.
If you need
I
it,
do. I have another.
you do, okay, no problem.
I'm good, thank you.
It's yours.
All set?
Yeah,
Great.
please.
Okay, so everyone has the presentation. We're not gonna show it on the screen, but we'll.
Yep.
Reference pages, okay. Well, first of all, good evening. Thank you very much for inviting us here tonight. And on behalf of the entire team at Walter Scott, that's 170 people in Edinburgh, Scotland, and 10 of us now in the US. Thank you very much for the investment that you've made with us. We truly appreciate it. We take seriously the role that we'll play in acting as a responsible steward of your capital and in delivering investment return that supports the program here in Norwalk. So it's truly appreciated across the organization, and we understand the important role that we play. My name is Laura McDonald. I'm a client investment manager in the firm's Boston office, where we have a client service presence. We're joined this evening by Alan Eddington. Alan is an investment manager on our team in Edinburgh. He's fortunately also a night owl.
It's even worse because we're on daylight savings time.
It actually is better. When we booked it, I thought it's a 5-hour difference. It's actually only a 4-hour difference. So he thought he was gonna be dialing in at 11, but it's only 10. So we're okay there. So our goal this evening is to provide an update on the investment that you've made with Walter Scott. This is our first opportunity to meet in person with all of you. I met with some of you virtually a couple of years ago when we talked about the firm. But you know, really, we want to provide an update. We thought probably as part of that, a bit of a refresher on kind of the who, what, how of Walter Scott. But most importantly, we want to address whatever is most important to all of you, any questions that you might have. So is there anything in particular that you want to make sure we're talking about tonight?
One of the things you don't need to, usually we have done research on your faith in your company, so you don't have to get into like. It's been a long time, and this is person went to Oxford and anything like that.
Okay.
You know, we just want to get, you know, discuss the portfolio performance, what your feelings are, and that would be great.
Okay, excellent. How much time do we have?
All the time you want. I got a whole bag of chips.
Excellent. All right, well, settle in,
Chris.
folks.
Chris.
So, maybe I'll just start briefly with just quickly on the firm, and then on the team, and then Alan will talk about our investment philosophy and process. We didn't get to cover the process when we first met with you, so we want to make sure we, kind of share that with you, and then focus our attention on the portfolio, but, three key takeaways, for everyone tonight. The first is thank you. That's the most important message we have. The second is, it's just shy of 2 years since you made your investment. We're going to show you performance through January of 2025. So we're very long-term oriented investors, and from our perspective, that's early days. The portfolio has delivered about an 8% annualized return over that just shy of 2-month period. So reasonable from an absolute return perspective, but it has trailed the EFI index. So we're going to talk a bit about some of the positive drivers that have driven the absolute return, but also some of the challenges we've had in terms of those index returns. And then we want to make sure we leave you with an appreciation that the investment team does have a high degree of conviction in the portfolio that we're investing on your behalf, and in the ability of those holdings to generate capital appreciation that will serve your plan well over the longer term. There's a few things here on the firm, and again, I won't go through it all. But just as a reminder, Walter Scott, we focus exclusively on global and international equity investing, and we serve an institutional client base. So about 300 clients around the world, and we're focused on doing one thing very well. That's managing global and international equities.
Just a real quick question.
Mhm.
I had my own reason to ask. You were acquired by Mellon in 06, and then the Bank of New York in 07.
Yes,
How's that all going?
so 17 plus years.
I
It's
worked at the Bank of
actually,
New York, that's why.
oh, did you? Okay, yeah. So 17 plus years,
Yeah.
it's going quite well. It's a constructive relationship. The bank supports Walter Scott in a number of areas. I consider all of them kind of infrastructure like, HR, legal, IT, compliance. We're in BNY Space in our Boston office. They're a distribution partner for us around the world. But very importantly, and maybe I'll land in my comments on the firm on the investment team on page 7. But very importantly, from an investment perspective, we are able to operate very autonomously from the bank. So the folks at Walter Scott who are making investment decisions on behalf of our clients are the 19 people on page 7, and they are, there's a very unique culture to the firm that's been formed over 40 years in Edinburgh, and that is all very much, a Scottish-centric investment management firm,
Okay.
and the bank is a bit.
Good to hear, okay.
Yeah. So it's fundamental, this is fundamental bottom-up buy and hold stock pickers. Walter Scott's sort of differentiated on just a few dimensions. So one is, we've adhered to a consistent investment philosophy and process for over 40 years. So, we have what we think is a tried and tested investment approach through volatile equity markets, and they're always volatile. We stick to our knitting and maintain our discipline. Our investors are global generalists who follow a collaborative team-based decision-making process. So team-based process is a bit different, and Alan's going to talk about how that works in process. And then we take a resolutely long-term view in all that we do. So how we invest, average holding periods are 10 years. Many companies are held for much longer. How we engage with our clients and how we manage our business, including how we develop our team. So it's the investment team, the firm is investor-led. January and Charlie lead the investment team. They also lead the firm. It's the third generation of leadership. And it's a very stable and experienced team. You can see we're organized in different geographies. Over time, every member on this page will rotate through the different geographies, developing a truly global perspective across industries, companies, sectors, and geographies, and that informs our collective team-based decision-making process. And the focus, again, is on bottom-up fundamental research. Our overarching goal is to align our clients' capital with companies, businesses that we believe are capable of generating and sustaining wealth over time. And that's what the process is really getting at.
I guess we'd probably maybe jump to the idea of like what the portfolio holds, why it's underperforming. And I think those things are more important than
Okay.
whether you're been around 50 years or 500 years.
Okay, that sounds great. I'm gonna maybe turn it over to Alan to just quickly on the philosophy, Alan, and the process. And how we build the portfolio and the structure of the portfolio, and then we'll get into performance.
Right, maybe like where it's your philosophy and performance have not been in line with the market.
Okay,
The index.
The index.
the index. Okay, great.
Okay, so please do steer me if I'm not kind of fulfilling that request. I think I heard all of it, but not precisely. So in terms of the philosophy process, I'll do a very quick version. So essentially what we're doing is we're finding companies where we think earnings per share will grow from the bottom left to the top right of a chart over time. And of course, there'll be some volatility in that, but that's essentially what we're trying to achieve. Because earnings growth and cash flow growth over time is reflected in share price appreciation over time. That's the simple philosophy. The way we go about doing that is we have a series of tools that we use that have been internally developed and used in a very similar and systematic way for a very long time over the course of the firm's history, which try to assess the likelihood that a business can do that. So one is we look at the financial history of a business, how has it performed? We look for high margins, we look for consistent growth, we look for businesses that have high return structures, so companies that are generating a lot of profit, that demonstrates they're doing something special over time. And we look for companies that have strong balance sheets. So we want companies that are growing, we want companies that can fund that growth, not companies that are going to be challenged when the bank is closed at a particular difficult time in markets, for example. So this sort of starting point is this financial model. Do we like the look of this business? Do we believe it's a viable financial model that will drive earnings growth over time? Then we look at more qualitative aspects of a business. We have a tool we call the Seven Sisters, which is like a detailed analysis of strengths, weaknesses, opportunities, and threats. And it's the same series of questions, right? It's the same template questions that we ask you to analyze, the individual to analyze for every company in order to assess whether we think the business model is repeatable and likely to continue to be successful over time. So some complicated questions in there, like what are the technological risks to this business, and some really simple questions in there, but questions that we ask, like how concentrated is the customer base? Because if it's very, very concentrated, maybe you have a problem. But it's the same list of topics, every business, every geography, because we think that having good answers to each of those topics aligns you with companies more likely to be able to grow from that bottom left to top right of a share price chart. The kind of final part of it is we write down on one piece of paper, why do we think we should own this business? What does it do and why do we like it? Why do we want to own it? And then you have to convince the team. So we've got a pretty rigorous process where I present an investment idea to my colleagues and they kick me around, normally over the course of a number of different meetings. I often end up having to go away and do some additional research because someone's asked a smart question that I haven't considered properly. And so I've got to go away, do some more work and convince them. We fundamentally are saying in that process, we think that my bias can be eradicated by having a group of different and smart people around the table who all speak the same investment language, they use the same investment tools as me, but can challenge my assessment of an investment idea. So we come up with an idea, we agree we want to buy it, it goes into portfolios. We tend to own roughly 50 stocks in your portfolio. The starting weight is roughly 2%, so you can think of it as an equally weighted portfolio at a starting point. And then we let the companies perform, and we have a sort of really rigorous ongoing monitoring process that I won't get into because I know you want to talk about the portfolio itself. So I've skipped over effectively all the slides in the deck. Don't worry too much about them, but what's produced then, you can see on slide 25, is a portfolio that's diverse. Sorry, go ahead.
Before we get there, if I could interrupt with a question, say you start with an initial position size of 2%.
Yep.
And is there a process where you add to some positions, take off some positions? What do you start with the idea is equally weighted, but or is the portfolio actually equally weighted?
Very balanced.
Yes. So yeah, very valid point. And the portfolio does not end up equally weighted, so we don't rebalance the portfolio as a as a sort of matter of course. For example, if you take a look on slide 25, you can see the shape of the portfolio. Slide 26 shows you the top 10 holdings, and you can see that
Right,
that
right.
ranges from 2.4% weight up to 4.3. We have a
Right.
maximum internally set threshold, so we won't go above 5% in one particular stock within your portfolio. We just think it's better to sleep at night managing the risk
fine.
in that sense. But we're often having a conversation before then. So if a valuation goes up an awful lot and a stock goes up, do we trim that position? Do we sell that position? If something's falling and we think it's getting cheaper and yet the fundamentals are still in a good place, should we be adding to those? So, you know, over the course of the last 3 months, we trimmed Taiwan Semiconductor because it was knocking up against the 5% weight in your portfolio. We trimmed Adidas because it's had a sudden great run of form, but we think the valuation's a little bit ahead of itself. And we added to ASML, we added to Dassault, because we felt those businesses were underappreciated and undervalued in the market. So there is some activity around that, but it's largely
What-
discretionary apart from that 5% rule.
What did you kick out?
Kick out in the portfolio completely. We kicked out Nestle to fund those 3 top-ups. So Nestle, we ultimately concluded that's the most recent sale in the portfolio. And we had a bit of a battle about it. The individual responsible for the holding didn't want to sell it. So the important part of the process that I haven't touched on yet, I've got to get everyone, if I come up with an idea, I've got to get it past everyone in the team. So if anyone puts their hand up and says, I don't want to buy this, we don't. And on the sell side, it's the opposite. So any one person can drive a sale. We don't need any unanimity. You don't have to convince anybody else. You just need a good argument. If a smart person we've trained thinks we shouldn't invest your money in this thing anymore, then we should get out. And so Nestle was a debated one. Ultimately, it's growing a little slower than we would like. We think some of the multinational consumer goods companies are being challenged by local and regional players taking share. Nestle goes through periods like this, as do many of these businesses, where typically what happens next is new management come in, new management reset the margin, they sell some of the stuff that's not growing, they buy some new stuff, and actually Nestle's done that quite successfully over the years. But of course, during those periods, you have additional execution risk, right? Are they selling the right stuff? Are they buying the right stuff? If management resets that margin expectation, are we convinced the margin will then go on to sustainably expand over time, driving those high returns for that business? And if it can't, that's just a higher risk time to hold a Nestle. So
Yes.
when we had competition for capital, we drew the conclusion that that was the weakest link from which we should draw that the money to top up the Dassault, the ASML, and others.
Do you keep track of Nestle after you got out to see how
100%.
how your decision's
Yeah.
done?
Yeah.
Oh my goodness, yes. So we have this this pack, this Monday pack. So everyone in the firm sees it every Monday. So in trying to do the philosophy process quickly, I kind of skipped a couple of important steps, but one is of course the ongoing monitoring, right? So anything material.
What I'm going after is your decision process, so it's
No,
good.
yeah, I'm just contextualizing the answer a little bit for that. So we have this pack that goes around the whole team every Monday, any material updates, but all of the decisions sit in the back of that pack. So we're looking every week at, is it in red or green? The stuff we've presented and not bought. So we decided not to buy it. The stuff we've bought and the stuff we've sold. And how are those decisions tracking over time? And that allows us to then revisit those and conclude on where we've got a decision wrong, obviously.
You do any stats on that?
Yeah, so it's all
What your hit rate is, things you got out of, what their plugging ratio is relative to everything else.
Yeah, we do. And so when you look at the kind of, if you step back from it, we think we've got around a 60% hit rate over time on getting decisions right. And if you get a 60% hit rate, it tends to lead to pretty good portfolio returns. It certainly has over the history of the firm. But the big trick is that
absolute? That's 60% relative or absolute to the index?
that's 60% beating the benchmark.
Oh,
So making the right call versus yeah. So we think over time it's roughly that, but of course the big when you look at the real impacts on the portfolio, it's the big winners and the big losers that have the biggest impact. The actual core, you know, the core of the portfolio chugs along doing fine, but doesn't drive the performance, right?
Alan, at the risk of hopping around a little bit, I'm looking at page 40 and, you know, for the years leading up to 21, you were consistently beating the index. But that's not been the case the last 2 or 3 years. Is that US interest rates getting slammed, or is there some other story there? What's that tell us?
Yeah, so it's a good question, and I think it will help contextualize the sort of more the more recent performance. If I could show you slide 34 just before we get into that conversation. 34 shows you the typical pattern of returns from Walter Scott, right? So these are the capture ratios over 30 years. What it's showing you is in months when the market is up, we've tended to capture 90% or so of the upside. And in months when the market is down, we capture less of the downside, right? So we tend to capture 80% of the downside. These are averages, of course, so there are times when it doesn't look exactly like this, but this is what it tends to spit out. And so by investing in high quality conservative businesses, they tend to do well when market's down, and they capture most of the upside on the way up, but not all. But when you have periods of market volatility, your portfolio holds water a little bit better. And then when markets rise and you capture most of that upside, that's tended to be what's led to the long-term outperformance. So then if we go back to the slide that you were on, slide 40, what you see, I think, is a fairly typical pattern for Walter Scott. You know, if you just started at 2017, 18, you know, actually 17, we're capturing a little more of the upside than you would typically perhaps expect. 18, we captured sort of less downside than the benchmark. So kind of as you might expect. Again, 19 and 20, the composite's going very well relative to benchmark, perhaps more than you might expect from a Walter Scott portfolio. 21, similarly keeping up with benchmark. 22 is the notable change. 20, which I'll come back to. 23 again, keeping up with slightly beating benchmark. And then 24, again, material weakness relative. So the two bits that I pick out there, 22, we had this big value growth rotation in Q1. So all of the kind of quality growthy stuff that we like fell out of favor in the first quarter of the year. Everyone piled into value stocks. It was short and sharp, but it did enough to, in a down market, to derail our performance relative to benchmark, and so resulted in a kind of weaker year. We've seen those a few times. That was 22.
Rising interest rate.
Yeah.
So you can see that down market at down 15 or so, and we were down about 23%. And that was the sort of interest rate rise, market leadership shifted, everything that was kind of growthy and high quality was sold off, and everything that was more value-y, more commodities type businesses all rode high for a short period. We see that periodically. You know, growth isn't always in favor. The value rallies tend to be relatively short and sharp over the history of our 40 odd years of doing this. And so we don't think there's a sort of fundamental long-term challenge there, but it does result in the odd year like 2022. And then, of course, we come to the more recent performance, which is what ultimately has been, I think, most challenging for the portfolios, and is what has impacted the numbers that you see for your own particular assets within our portfolios, and that's 2024. And actually, 2024 again doesn't look like a particularly unusual year for us when you look at Q1, when you look at Q2, when you look at Q3, but Q4 was where we were really significantly impacted, and that's driven because of the sort of size of that number, that's driven quite a weak year for 2024. And what really happened there again was a market sell-off, but the things that performed in that sell-off were quite unusual. So particularly financials in Europe and financials in Japan held up really well in that sell-off, and we own very few financials. We own none in Europe, we own none in Japan across your portfolio. And so the one time that Walter Scott portfolios do tend to significantly lag a benchmark is when financials are off to the races. And you can see our exposures if I take you back to slide 25.
25, yeah.
Yeah, so on 25 you can see, and as Laura mentioned, our turnover is relatively low, right? The portfolio turns over about 15% a year typically. And so we don't shift these allocations very often. We should say these are bottom up. It's not top down driven. We're not saying we should own more information technology. We're saying we found some great businesses in IT and therefore we have a significant weight there versus the benchmark. We also have found with financials, we can't find businesses that we think are growing fast enough to ultimately drive share prices higher over time. And we also have struggled to find businesses that are higher return in financials unless they're doing something pretty exotic, which obviously makes them slightly riskier. So it's not that we don't own financials, but it's that we don't tend to own many. We're quite cautious around how we do it. But of course, with that sort of underweight, if financials really take off, that can be a real challenge for
Excuse me,
portfolios.
can I ask a question? What was
Yes,
your
of course.
performance in February? I mean, these are January numbers. I'm just curious because this market was quite strong in Europe
Yeah.
in February.
Yeah,
and
so-
what's your performances in February? And then what it
So I
is against
can,
the indexes?
yeah,
I have that,
yeah. So I
Ellen.
think
You
you've
have
got
it?
the specific numbers.
Yeah,
So
for the group.
maybe you go for that, and then I'll talk about the explanations.
So, for in the month of February, the index was up just shy of 2% and the portfolio was sort of flattish down about 20 basis points. Similarly, so far in March, the index, the equity markets, international equity markets have been strong, up about another 1%, and the portfolio is flat month to date through yesterday. So on a year to date basis, the portfolio or quarter to date, the portfolio is at around 2.5%, and the index is at around 8.5%. So we're continuing to underperform in the year to date period.
Thank you.
And I think it's a lot of the same, Alan can speak up, it's a lot of the same type of headwinds. There's been a really strong outperformance of value. When we look at the period of time which you've been invested in the strategy, and I think that's also continuing in these markets, but Alan may be closer to it.
Yeah.
Can I ask another question?
You can ask her.
Yeah, of course.
Like, for example, you have materials overweight. Are you gonna be changing that because of the possibility of tariffs, et cetera? And how do you see, the tariff potential, trade war? How does that affect your
Yeah.
portfolio moving on that?
Yeah, so the tariffs question in lots of ways is kind of a nice analytical thing to look at because we looked at it all in 2017 when this happened last time. And what we concluded at the time was that the portfolio companies are pretty well insulated. These tend to be businesses that match their production with their revenue basis. So for example, if I'm selling stuff in the US, I tend to have my production base for that market in the United States. Where they are importing materials, etc., these tend to be multinational businesses with complex supply chains, but also very sophisticated supply chains that they're able to shift around. So we don't think many of your portfolio companies have significant exposure that we have concerns around with tariffs. One example where there is a little bit of nervousness, and we're sort of debating this at the moment, is Diageo, the beverage company. So they sell largely spirits and premium spirits. And about 45% of the businesses in the US and about 40% of what they sell as input costs that come from Canada and or Mexico. And so there is potentially a reasonable amount of tariff impact on Diageo. When we speak to them about it, they're reasonably confident that they can put through price being at the premium end of the spectrum, particularly when, what you're importing might be tequila, where anyone who's selling any tequila, they're all going to face that same challenge. And so they're all going to have to increase price on the consumer. That's how tariffs went last time. These businesses all kind of fell in line and passed through. But we recognize that it's a big-ish portion of their portfolio that is exposed. And ultimately, if that has a downward pressure on consumption, it could impact Diageo. We think less so than the other drinks businesses because it does tend to be higher end where the customer is a little bit stickier and a little bit less sensitive to economic pressures. But it's absolutely I think that's the one that we worry about. In terms of your materials question specifically, the benchmark 6% materials, we're only 4.4, so we're kind of underweight. but the materials businesses we own tend to be at the higher value add end of the materials spectrum. So we're not talking about selling steel pipes, right? I mean, there's a bit of that in Shin-Etsu Chemical, which sells some PVC piping into the housing market in the US. But Air Liquide, for example, is an industrial gases business that does air separation. There are about 3 scale companies or 4 scale companies in the world that can do what they do. They're not selling nuts and bolts to anybody. And so again, we're not so worried about that particular business in the context of tariffs. So yeah, we've done the work. We refreshed all the work we did in 2017. Of course, tariffs will have peripheral impacts on plenty of the businesses in the portfolio, but we think they're all pretty well positioned, other than Diageo, which we continue to debate a little bit.
Pacific ex Japan, how much of that is Asia? I mean, how much is that is China?
So there's no direct investment in China in your portfolio.
It seems like you're placing pretty big bets on your sector selection. I mean, I'm not sure whether it's implicit or whether it actually is explicit. I mean, how do you evaluate that most risk reward around that? And what's your process for actually determining that you're either, you're taking on too much risk relative to the index or not enough risk?
Yeah. So the way we do that is not a top-down bet. It is a bottom-up set of decisions. So we're not saying more IT is good, less financials good. We're not making a call on kind of timing our way in and out of these things. We're finding what we think are great companies that will do the job in various environments, whether the environment's good or the environment's challenging, when given time. And then we apply a sort of commonsensical approach to how much risk is too much risk. So if the next 4 investment ideas that came across the desk were in information technology, there's going to be a big conversation about, well, hang on a minute, how much information technology do we want in the portfolio? But there's also a really conscious understanding of the underlying exposures of the businesses, because what MSCI tells you by classification is information technology can be impacted by a huge range of different drivers, right? And so some of the information technology space can fall into trouble tomorrow, and the rest of it can do perfectly well. And so we want to understand those sorts of exposures within the portfolio. So by trying to make sure we don't kind of double up on too many bets, we manage and having a diverse range of companies within each sector, we think we kind of navigate that reasonably well. And so an example would be Dassault Systèmes is a 3D software business, right? If you're designing a car, you're designing an aeroplane, you're anything like that, chances are you're relying on Dassault Systèmes software, whereas ASML ultimately is about the leading edge of physical hardware for semiconductor manufacturing. It's kind of miles away from Dassault. If ASML is doing well, Dassault can be doing terribly, and vice versa. We don't see them as kind of intrinsically linked in terms of their end markets or the likely impact on those companies. So we think we've got quite a diverse spread. That's how we talk about it. Our investment executive, which we've not really touched on because of kind of time on philosophy process, but the final decision-making group on how much exposure we should have to particular things in the portfolio is Jane, Roy, Charlie, so our 3 executive directors, and the other 2 most senior members of the research team. So they have a kind of final say on monitoring all of that, but we all input to, hang on a second, are we sure we want to buy another thing that looks a little bit too much like the Taiwan semiconductor business that we have today? Something that's reliant on the same trends. So that's how we tend to think about managing those exposures. So it's not, we're taking an IT bet, it's we're taking a bet on these 10 companies that we think are excellent and relatively diverse.
What was your philosophy on being so underweight financials? Because I mean, they did have quite, at least in the States, they had tremendous upside moves. And it seems that,
You said they're not growth.
yeah, but I mean.
They don't grow enough
Well, right.
internationally.
Yeah, maybe that's it. I mean, but the benchmark, they're so far away from the benchmark.
Well, they don't.
I mean,
One thing I think in terms.
That's
I mean,
And that's not the growth benchmark.
that's not the growth benchmark, yeah.
That's the value benchmark?
No,
Yeah, no, it's the standard. measure, we're just gonna have both. I think
We track both in ours.
yes, and we have that on the performance page. I think
Alright.
one thing when we go through the process so quickly that just gets a little bit lost in translation is what our team is doing is investing according to very specific criteria, and it's part of the process. It's a spreadsheet, a very complex set of, it's a spreadsheet, it's not complex, but it's a very clear set of calculations, and they're looking explicitly to identify for all these companies, growth, profitability, balance sheet strength, return structure. And what they're doing is, and then valuation. And they're buying these companies on a bottom-up basis. We're not saying we want to be this much in technology or this much in healthcare. But what you see on page 25 is a fallout of that process. And it is the case that because of this criteria, we don't tend, and Alan talked about this, we don't tend to find a lot of financials that meet that criteria for a long-term durable growth.
In the
That we're looking
MSCI
at.
growth index finances are only 11%.
Yeah, it's
So
gonna be
there's
lower.
half of what it is in the overall
Index,
index.
general.
Right, so is it fair to say like, you're looking at Credit Suisse versus Taiwan Semiconductor?
Yes,
And the sector
Correct.
allocation is a byproduct of the individual
Yes.
names.
Yeah.
Yeah.
So that's the difference. Every company gets rated against each other regardless of what sector they lie
yeah,
in.
we're almost indifferent to how MSCI categorizes things. It's their business to sort of slice and dice these universes, but it's not how we think about things. We think about, this is our criteria. What are the companies that meet it? What is the valuation that we can buy them at? What is the growth that we can get over time? It is the case that we tend to find more of those ideas in areas like information technology, in healthcare, and consumer. So that it's not unusual to see that those over and underweights, but they're a fallout of the process.
Index, you compare that to page 40.
What was that?
I just looked up the MSCI growth index and their performance over time and looking at that versus the information provided on page 40. And so, I mean,
And I think it's worth, I
You're
think it's worth noting that Walter Scott within the pension plan is more of the growth
Right.
option in international equity.
That's right.
There are other international equity managers, the value manager, where they're gonna have a much higher allocation of financials.
Yeah.
And the idea is when their philosophy and process is in favor, we would expect Walter Scott to do well, and your other manager probably not to do as well.
Yeah.
And together over time to consistently outperform. There's certainly going to be periods like we've seen where Walter Scott's process has not been in favor.
Alan, since it's your largest holding, do you worry about China and Taiwan Semiconductor?
Yeah, worry about Taiwan Semi was the
Do
question.
you worry about China
Oh, yeah.
doing something with Taiwan Semiconductor?
Yes, I think less than
How much? A lot or a little?
a year ago. But yeah, I mean, of course we do. I mean, I think there are very few investments that Walter Scott have ever made and that we would ever take the risk of making in your portfolio where the actual asset could go to zero. You know, we can conceive of a reason that Taiwan Semiconductor just disappears and were China to roll the tanks in, which, you know, remains a possibility. I think well, we analyze it as a very low probability outcome, but it is possible that, you know, China decides to take over Taiwan and something kind of cataclysmic happens. Taiwan Semiconductor has been doing some pretty sensible stuff in rolling out fabs elsewhere, so they're diversifying geographically a little bit, which we think takes some of that risk away. We also think ultimately it's so important to the global economy. You know, if the US wants AI, Taiwan Semiconductor cannot stop. They can't let that grind to a halt. If China wants to continue to advance down its own AI agenda, then Taiwan Semiconductor is going to be a vital component of that as well. And so this thing is a very, very important asset globally. We think that it therefore is unlikely that China sort of does anything that ultimately ends up pulling the plug on TSMC. But we do think that it's, you know, you have to consider that that's a possibility. So we take very limited risks of that sort, which is why it's only with one stock in the portfolio. And we also have consistently trimmed that holding over time to make sure that we think it's in a reasonable range in terms of its weight in your portfolio. But it does have a valuation discount because people worry about this, right? TSMC is, if you think about the quality of that business globally, no other foundry can touch them at the moment. You're seeing Intel kind of falling by the wayside consistently. It could easily trade on a multiple twice of what it does today, and part of it, the reason it doesn't, we think, is because it's based in Taiwan. So you're getting an opportunity to buy something relatively cheaply, but there is, of course, that big risk in there. So we've talked about it, we've debated it, we've spent time with experts, both here and overseas, around geopolitics, and you know, our best estimate, I guess, is that the status quo probably reigns. But you know, it is an estimate, and we do, of course, as I say, we do worry about that. We do take it very seriously, but we think where things stand with TSMC, it's worth taking that bet.
I wouldn't worry about tanks rolling in. I'd worry about them just coming in and saying, we're gonna take all these chips. Thank you very much.
Yeah, well, I think that's what Donald Trump is
Any
worried
random
about,
behavior.
Yeah, okay.
and why it's happening, and you know, why they're fabs in Arizona, right?
Yeah. But that's how many years away is that?
Therefore.
Oh, so there's production already in Arizona at Fab 1.
Okay, good.
Yeah. But ultimately, you know, America needs those chips too, right? So the chance of China being allowed to walk in and take them all feels slim. But again, then you're into the sort of, how does this end militarily? Does it not? What's the
Right.
solution? So I think it's in everyone's interest to keep Taiwan semi producing at the moment, and that's the kind of base case.
Okay.
So we can go look at your portfolio, your performance returns specifically, but maybe just before we do that, touch just briefly on page 32, just shows you, we've talked about the types of companies that we're looking for, the attributes, how we're building the portfolio. Once we put all this together, what you end up with is a portfolio with, you know, better growth, better return structure, stronger margins, strong cash return on capital employed, lower debt, and we pay a slight premium for that. So the sort of the characteristics of these companies, we would argue, are higher quality on a number of different metrics. On page 22 is your specific performance experience. This is just shy of 2 years. Again, these numbers are through January. But over that period, your investment has grown from just shy of 31 million to now just shy of 36, so about $5 million in appreciation. This performance grid is really busy, particularly for such a short period, but we've sliced and diced it a couple ways to give you a little bit of context, maybe. And also there's some, you know, regulatory requirements and periods we have to show here. But I think, you know, we're showing net returns of the portfolio. We're also showing it relative to EFI, and to the point made earlier, EFI growth. As a reminder, the primary attributes for the strategy are growth, profitability, balance sheet strength, but also a real valuation sensibility. You know, when we look at the portfolio, does tend to tilt towards growth. We're indifferent to how MSCI kind of calls growth and value, but when you disaggregate the portfolio, you do look at a weighting of something around 80% companies that they would call growth, and around 20% something that they would call value. And one thing that does is in short periods, when you have these sharp, swift growth value rotations, is the portfolio can kind of get buffeted around a bit by that. But over the long term, what you should see is that the portfolio will outperform the EFI index, as well as EFI growth and EFI value over longer periods. That has been the performance history to date. So looking at your specific experience, I think probably just compound annual growth rate is the simplest. This is an annualized since inception return, just shy of 2 years, 8% net. As you can see, it's slightly below the EFI growth index, but it's meaningfully below that EFI index. And again, that has been driven by the outperformance of, there's been a sort of value growth dynamic going on in the market. The value index over the time period you've been invested has returned almost 16% during that period. So you have seen strong outperformance of more value-oriented type of companies. There's also been a few things in the portfolio that have been challenging, so we're going to make sure we talk about that. In terms of the attribution specific, that's on page 23, everything on the right is relative to that EFI index. Everything on the left are sort of the absolute drivers of the portfolio. There have been, there's been some strong positives and there's been some challenging areas on that relative performance basis, but maybe starting with the headwinds, the positioning and financials, which we've touched upon. The portfolio is underweight. It's been a strong period for financials returns. The companies that we do own are Asian life insurers, and those have had a challenging run, particularly given exposure in business in China, and we'll talk a bit about that. There's been weakness in a number of industrial holdings in the portfolio, to some extent reflecting a challenging global industrial backdrop. Japan has been an area of challenge. That there's been some things in Japan have been working very well in their equity markets. The type of companies we own have not performed as well as some of the companies that have been doing better. And we can talk about that. And then China. So Alan mentioned there's no direct ownership of anything in China in this portfolio. That would be an emerging.
Is that a decision? I mean, is that, you could own China?
We could, I believe the guidelines for this particular, this is a commingled vehicle. I think we could own up to 15%. If we could go up to 15% in emerging markets. I'd have to check that number, but it'd be something like 10 to 15% if we decided to.
Right.
But we are not doing that. We do have an emerging market holding, and that's Taiwan Semi, which we've been talking about.
Right.
But there's nothing else that's China, nothing directly owned in China.
That was a slip.
There's businesses. I missed it.
Well, you said
Nothing else changed.
that's your own in China.
Oh, yeah.
There's nothing else.
That's our only emerging markets holding. But we do own these leading global businesses, some of which are based, in Japan. Some of which have significant or have meaningful exposure to the Chinese market. So the slowdown there has impacted them. And sentiment for anything tied to China has been really, really difficult. So companies have executed okay, but if the business tied to China, the stock market hasn't really appreciated that. But then on a positive, you can see at the, on the top of the page on the attribution, in consumer discretionary, in information technology, and also in healthcare, a number of holdings across the portfolio have performed really, really well over this period. And we touched on earlier the fact that IT and consumer discretionary and healthcare are sort of three areas where we tend to find a lot of ideas that meet our investment criteria. So it's an encouraging sign that we're finding the ideas there, and the names that we're choosing are doing quite well. So we touched on Taiwan Semi a bit today. That's one of the better, that is the best performer in the portfolio. This is over your holding period. SAP, ASML, other names, in consumer discretionary, some very strong performers in Inditex, Adidas, Ferrari, Compass, and then in healthcare, Novo Nordisk. So puts and takes, but there are some things in the portfolio that are working very well, and that's driving that 8% annualized return, but there are other areas that have been weaker.
The selection effect, Japan is about the worst.
Yeah.
What was it that what were you selecting, or what were your criteria to select the stocks that underperformed?
Our criteria is always the same, but I'm gonna let Alan talk about that.
So what has happened in Japan is, as interest rates have taken off a little bit, there's been a little pickup in inflation. Everyone's gotten really excited about some changes to Japanese corporate governance. It's going to become a little bit more shareholder friendly, is the kind of idea. Corporate sort of Japan Inc. has taken off in terms of share prices, and it's a case of some of the worst companies are most benefited when the environment gets a little bit better. And so all these ships are getting lifted. So, Warren Buffett's bet on the trading houses, which are fundamentally not particularly good businesses, not particularly growthy businesses, but do stand to benefit from a short period of interest rate rises. That's a kind of what we would call a trade rather than a long-term investment, right? Whereas we're making long-term investments in high-quality Japanese businesses, typically with a bit more of a global reach rather than Japanese domestic, and so less likely to be obvious beneficiaries of an improving domestic Japanese environment, but ultimately better position businesses to grow into the long term. So some of the kind of quality compounder long-term growth stories that we invest in just haven't been in favor as much in Japan, when some of the weaker businesses that stand to benefit from a slightly better environment sort of improve in a sort of short, sharp period of time. So I guess it's an argument for the sorts of things we like haven't been in favor, but we haven't changed much of what we invest in, and our criteria has remained the same throughout. We've been invested in Japan for decades now. There's also been an element of, as Laura mentioned, industrial weakness globally. A number of the Japanese businesses we own are industrial specifically, and so that's been a challenge versus the rest of the Japanese market. And as Laura also mentioned, a number of our Japanese businesses have material exposure to China, and anything that has kind of associations with China has been out of favor in sentiment terms since the kind of the US and China have had geopolitical wrangling, shall we say. And so something like SMC Corp is a factory automation business. It's the #1 player in its field. It does pneumatic equipment for factory automation. It takes market share consistently every year, but we are in a downturn in industrial, so it's turning out some negative numbers, as is normally the case. But there's also a good portion of that business in China, and that association we think has hurt sentiment around the stock. Whereas actually what we're seeing now are some green shoots in factory automation picking up again, and China's running just as smoothly as Japan and elsewhere. So we don't think there's anything wrong with fundamentals, but we do think there's been something wrong with sentiment, which ultimately can allow us to consider buying some more of these businesses if we think they're not broken and sentiments turned against them for a while. So that's an example. AIA Group is one that we've topped up. That's one of the life insurers that Laura mentioned, not Japan-based, Hong Kong-based, but has a decent China exposure, and it's still growing at 20% a year. It's consistently churning out a 20% growth number, and we've just watched the valuation go down and down and down over the last year as anything with the big China association has just gone out of favor. So we think we're being presented with a pricing opportunity in AIA, so we've added to the position over the course of the last few months. So that's the sort of debates we're having around the China exposed stuff and some of the China exposed Japanese industrials as well.
Anybody have any other questions?
I'm good.
Well, thank you. very much.
Thank you.
Appreciate
Thank
it.
you.
Thank you, Alan. Good night.
Thank you.
Yeah,
Thank you.
Thank you. I'm leaving
Thanks,
this
Laura.
here. This is,
Thank you.
thanks, Al. We do a research conference every 2 to 3 years, and we'll be doing our next one in May of 2026. So it's a couple days in Edinburgh, Scotland, and certainly we'd love to see someone from the city of Norwalk there. You get a warm welcome.
Nice golf day.
leave my golf clubs home.
But it's here, and we can send
Too
them the
embarrassing.
information.
Thank you.
Thank you.
Might have to cut back on the chips.
I want chips.
A nice golf location, yeah.
I have a 12-year-old son, and I was listening to something in my car, and it was Bloomberg Television. They were talking about a global chip shortage. And he was like,
Oh,
there's a
no.
chip shortage. I said, no, not those kind of chips. I should clarify.
Is he a Celtics fan?
He is a Celtics fan. He's a basketball player too.
Oh, good.
All right, everyone have a nice evening.
Thank you.
Bye. Bye.
What's anybody think? I was all psyched that we had money in overseas after all this time. Thanks, guys. And I'm going, yeah, I mean,
Well, but
Well, relatively, it's still,
Yeah.
if they're,
relative,
if they're
Really?
flat year to date or whatever it was, I mean, the
Yeah.
US down over 10%.
If you believe their 60% pick rate, that's good.
yeah, they stay in stuff too long.
They're very long-term,
That's a problem.
very long-term
well,
investors.
even when they were talking about like their 10th largest holding is only 2.4%. I mean, I almost felt like, I've always believed you add to your winners, you sell your losers.
Yeah.
And it almost sounded like, to me, it's like, okay, we bought this stock and we believe in it, so now we have 2% of it, now we only have 1.5%, we ought to buy more. To get back to 2%, their philosophy is their philosophy, I'm just saying.
Yeah, yeah.
You know,
Yeah, I'd say over long time periods, they've done very well. I think
Yeah.
in shorter intermediate periods. They're very different than any benchmark that we're gonna put in a performance.
I mean, should we have a different benchmark for them, or, I mean,
There isn't,
could you meld two of them and say, okay, this is like our.
in the
own
short
benchmark?
term, the benchmarks aren't gonna be. You know, they're a guideline, but they're not something they're aspirating to, so
Yeah.
to speak.
And
Yeah.
benchmarks can get really distorted.
Yeah.
Yeah,
You know, there's some in the US right now that are extremely distorted because of, you know, like Nvidia distorts the S&P, you have some
Yeah.
small cap crypto companies that are screwing up the Russell small cap. I mean, so they can get really screwed up.
Yeah, and I think that's another reason we look at them versus peers, and over the last 2 years, they haven't done very well. But, you know, in my personal experience with our clients invested in Walter Scott products over the long term, they've done extremely.
but there was a pretty funny slip when she. I thought-
In China.
I don't know if you guys caught that, but she said, that's our only China holding, I'm
Yeah.
like, wow, does she know something we don't know? You
Yeah.
know?
That's. What could go wrong
Anything else about Walter Scott?
I really like the way they keep track of stuff.
Mhm.
Yeah, that idea of, you know, how are the things keeping track of not only what we
Are doing.
are doing or holding, you know, but that, all right, raise capital to go into these by selling this, how's that doing? And so I thought that was
Yeah.
then that's, in my experience, is unusual.
I mean, I appreciated her giving the exact, you know, like, okay, what's February, stuff like that. You know, good. You know,
Okay.
anything else about that? No. I believe you're up next.
This is the one we have electronic.
Yeah.
right?
Just summarizing what we did last week, last month.
Did you forward it to the board?
Yes.
What I sent to you?
Yeah.
Okay, yes.
I got it then.
Yeah, I got it too.
Okay. Anybody want a hard copy?
Oh, good. I'll
Sure.
have
Okay.
it on.
Oh, you have it up there, perfect. All right, so, thanks for having us back, I'll be back. I just wanted to kind of follow up our discussion from last month regarding the actuarial assumptions, that we proposed in our study. We're kind of working through the 2024 valuation process. Just kind of want to get the board's final thoughts on that, and if the board agrees with our recommendations to the changes in the actual methods and assumptions. So I'll start on slide 2. We talked about the layered amortization method. That was our recommendation. I went through that probably poorly example of buying a house and then adding additions. So I've expanded on that through this next example, and a kind of a forecast of where this portfolio or where this plan, one of these plans could be headed. So we'll skip to page 4. So there's a lot of numbers here, but I'll kind of take it from top to bottom here. So right now, this is the police plan, by the way. I chose one of the plans. So right now, the police plan has an unfunded accrued liability of $56 million. And we have a 13-year amortization period remaining. So the amortization payment is about $5.4 million. So what we did is we modeled the next 10 years. Okay, and we modeled a better than average, slightly better than average returns over the next 7 years, followed by a recession type asset. After seeing this week, maybe I should have done the recession earlier, but we did, we put a recession type asset loss in 2030. So if the plan, if, again, this is a hypothetical example, one of many, obviously, that could happen. But this is an example of what could happen if this recession type of asset loss happens when the amortization period is pretty low. So the second box there is if you continue on as is, in 2033, 10 years from now, the unfunded accrued liability will be $70.8 million, and you'll have a 3-year amortization period left. That payment would be $24 million to pay it off. Okay. The last box on this thing is our layered approach to this. So the initial unfunded, that first line of the $56.7 million continues to get paid off. That has 3 years remaining. Okay. And the remaining balance of that is $20.36 million right there in the middle. And the payment for that is $7 million. So again, we're continuing to pay that balance off. And you can see we had some experience losses followed by a couple of years of gains based on the investment portfolio. And then in 2030, we have a rather large experience loss, and we have it for 4 straight years because of the asset smoothing that we do on the portfolio. So, but those periods would have, those layered bases would have 15-year closed periods themselves. So each of these, you kind of build this up as we go. So you have a very similar unfunded in 2033 that you do in the box right above it, but the payment is only $11.6 million. The blended amortization period is 7 years, if you blend all of these together. Again, this is a recommendation, certainly does not have to be adopted by the board. It's just, again, and I put it in graphical form on page 5, just to give you an idea of, you know, the unfunded payment stays around the 5 million mark. And what we want it to be level. But you know, you can see it grow.
Why wouldn't we
if
do
get
this?
that loss?
Well, why wouldn't we do this?
You wouldn't do this if you were following protocol on the funding policy now is to close off the unfunded and pay it off in 13 years. And if you do that and make your contributions, you'll be at 100% funded in 13 years. Okay. It's just that you could have a volatility in your contributions. That's what I'm saying here. If you get a large loss in a year where you have such a small period, you have a lot more volatility, as this line shows, as the orange line shows.
Is this the more responsible thing to do? Is it the more, fiduciary responsible?
Most plans are going to this layered amortization approach. As we get these plans who set up these closed amortization bases 20 years ago, we're starting to see them get down into this 10-year range. Right, you closed it off 17 years ago at a 30-year clip. As we're getting there, we're starting to get worried about if there's volatility that occurs in the market like we've seen and could see. So most plans are going to this layered amortization approach. Again, we're still paying off that $56 million off in 13 years. There's no change to that. It's just what are the experience gains and losses in the next few years. Again, they could be zero.
Yeah.
And we're in the same boat that we're
We
at
need to
now.
vote on this, or I mean, what do we do here?
Well, before we go, so
I've got a couple other.
from the city's cash flow perspective, if we stick with the current plan versus going to the layered approach.
Yeah.
Is that the difference between these numbers here? Is the
Well, again,
city
this
paying out
is,
more initially, less over time?
you would pay more initially, yeah. And then it would It would be,
7 million versus the 5.4. Is that right? Am I reading this
I'm
right?
sorry, where?
I'm on page 4, the amortization
The
payment.
top number, the 5.361 versus the 7.032.
Would the city pay out more the year we switch?
Well, you're on a level percentage of payroll, so that 5.3 is growing at 2.75% every year. That's our assumption that it's going to grow, and that's been the methodology that's been in place for the last 17 years. So
This has changed twice since I've been on the board.
Mhm.
The board has never voted on it. This is a decision the city makes,
Mhm.
more specifically, a gentleman to my right.
Mhm.
But that's at least, I mean,
Well, I'm just trying to understand from what his payments are gonna be and.
because Henry didn't, when we lowered the assumption,
6.5.
down to 6.5%.
Mhm.
One of the things was, I had even talked to him and I said, well, in the past, when, Tom was the financial director, I can't remember his,
Hamilton.
Hamilton, right? He kept moving it out. What we would reduce our bogey and he would reduce the amortization. So he didn't have to, so he didn't change how much we would have to be, the city would have to be contributing. And the same thing with Henry didn't want to do that, which I admired him for that, so. In my experience here, there's been, two different people did two different things. And really, it's not for us to decide if you want to smooth it out or if what you feel is best, for the city's budgets, I guess, is really.
Yeah, and this is kind of a middle ground. This is not, we're not pushing the whole thing.
Yeah, no, but what I mean is if
Opening up the whole
you
thing.
want A or B,
Exactly,
we
right.
don't have a say in that.
Yeah.
That's what I mean.
Yeah.
I mean, I appreciate that you're here and it's good for us to understand this better.
Yeah.
But the ultimate, I believe the ultimate decision will be the cities and your.
Is this, so, because I think part of this discussion was to look at the experience study and look at the assumptions that you're recommending to include into going forward.
Right.
Would this be included in as one of those recommendations? I think that's the question, because if it is, then I would think to whatever extent the board has weighed in on approving those assumptions that this would be part of those, and the board would have some say in those, unless you're treating this differently than you do other assumptions.
No, well, an experience study reviews all actuarial assumptions and methods that go into the calculation of our valuation reports. So this is a method that we use to come up with the contribution requirement that we give to the city each year. So it is. I
was gonna ask you, when you say the pension plans are moving towards this.
Yeah.
Of your clients, what percentage is now doing this? How many have moved? How many have stayed?
almost all have moved.
So to me, I think it makes sense. I don't know if it's a little bit too early, if it's, or.
We can
what-
wait,
What
we
the
can-
time, what.
We can
the
wait,
right time.
yeah, I mean, you've got time, obviously, we'll provide you with whatever models you want to look at, so you can see, this is just one hypothetical investment. Experience over the next 10 years, but you can look at it and I can show you, we can give you documentation on it. We don't have to make this decision today. I just wanted you kind of to be aware that, this helps reduce the risk for the city's budgetary responsibilities going forward.
So it's less volatile, but
But it
more,
could,
potentially more payment up front.
it depends what the experience gains or losses really do. If we have a lot of good years, we're gonna make headway earlier and pay this off earlier.
The drawback to waiting is just that you get a drawdown in the market in the interim.
Right.
And you get slammed at the end then.
It's just, again, what we're worried about is when you have a 5-year amortization and you lose 25% in the market. Again, we're not saying that's gonna potentially happen, but there's a possibility that that could happen. Then you're paying for that loss over 5 years instead of 15. So it's just, think of your mortgage, you bought a big house and you're paying for it over 5 years versus 15 years.
Just, weren't there actually some years that the city did make contributions or very small contributions?
Not
Back
since
in-
I've
not-
been
I mean,
here.
like, when the market was really moving in 05, 06, 07.
That's why a lot of the state
There
plans.
was a lot of the state. plans, and I-
After the late 90s, a lot of folks took, or a lot of plans took big contribution holidays. Because they
Yeah.
were over 100% funded.
Right,
That's why, then
They're paying for it now.
now they're paying for it, yeah.
So is there any end date on that? Are you proposing end like 20 years or something like that, or is it just open, it's open-ended? Or how,
It's still,
on the new,
it's still closed, so you see that, in 2024, if we were to do this. The loss we have for this upcoming vow would be paid over its own 15-year period. So
Oh, I see
then
what you're saying.
in 2033, it has 6 years left.
I see what you're saying.
but why wouldn't you say with a couple of years left that we should do it again? I mean, it seems like.
This would solve it, we would never have to change it again, we would have 15 years on every vow basis. So
And we lost 30% with 2 years to go.
That won't happen anymore,
that won't happen anymore.
because every year you get a new 15 years.
That's what I'm saying, so it's never, if every year you get a new 15 years, then how do you ever pay it off?
You would pay it off if all of these other numbers, it's better on the screen. If all of these numbers after 2023 add up to 0. If you have gains and losses every year, which we anticipate, if our assumptions are right and the 6.5% investment return assumption is right. Hypothetically, all of these numbers should wash out, so you will be 100% funded in 13 years. That's our goal, but this just gives you the coverage just in case we have a negative event.
Yeah.
In any year where we're down to a low period. I mean, you could do it at that point. If we have a negative year in 2030, we can make the change, you can make the change then. There's nothing wrong with doing it then. The actual community's fine with that. So if you wanted to wait until then, until that event happens, that's available as well.
That'll be you guys.
Not our vote, it sounds like.
It's not our vote. It is not our vote. I mean, this is for information only.
Yeah.
But really, this is a city decision. Whether you guys, how much money you give us, we invest and we do our best.
Right. Yeah.
Yeah, right.
I guess I just
If we had a
want,
ball, we would pass it.
I wanna, I guess I just wanna understand then, so when you vote to either approve or decline or change whatever the recommendations are, it's just you're looking at it, it's a recommendation, and we can, as usual, we can contribute as much or as little as we want.
Yeah, I think the question is, we need to vote, but it'll only be a recommendation from us,
recommendation.
and then.
Right.
Pierre will decide what he wants to do with that. Right.
Yeah,
Right.
I mean, do you want to vote to make a recommendation? Is that what you'd like us to do?
I think, that's why we came back, because I understood the board to think that you guys wanted to make a recommendation or to accept the recommendation being proposed. That's why we came back this month.
I don't know if it's, I don't know what's in the board's charter.
That gets back to Tina's comments earlier about marrying the plan. I think with what's in the charter is very, very, very limited and what
Right.
your purview, it's investments.
Right, and we
That's
have never actually, to my knowledge, never said, we recommend this. That we voted, that's not been our
I haven't
policy,
seen it before.
right, and I
Hasn't been
haven't
brought
seen
up
it,
before,
so,
so-
Yeah.
but part of that was, I think it wasn't brought up before, because like Tom Hamilton never said, what do you guys think about extending this? Or Henry didn't say, what do you think about not extending this? Those were
They
decisions
just did it, yeah.
made, and like you said, the chart is pretty specific, we invest the money, and that's really it.
Okay, but not a voting matter, in your opinion.
Yeah, it's not a voting matter in my opinion.
I personally like to see all this to give me a better sense of what our bogey is.
Yeah.
Yeah.
You know,
Well, and it's good for us to see it on the city side too, because we can. Rather than, when we're making decisions about how much to contribute, we can tie it to something, to some change or some recommendation, rather than just kind of, we're gonna cut 2 million out this year, or, we can actually make decisions based on something. That's, methodological or.
Right.
Yes, we have the actuarial recommendation, and.
right,
doesn't-
I think you got a sense from that nobody here is saying, we don't want to do this under any circumstances, right? So,
Yeah.
You can kind of take that as a.
So wink and a nod, yeah. Okay.
All right,
All right. I know there were other questions from last month's meeting, just on head counts of terminations, just go to slide 7. You guys had asked, this is the number of terminations that we saw, we just put it into service levels, just to give you an idea of where we were, and where the city is seeing, folks withdraw from the plan. And we saw a lot of police, obviously, in that 5 to 10 service range. So they're vested, at 15, actually, from 5 to 15. Most of the terminations were within that range.
When do they vest?
Are they vested with a pension, or they're vested with just simply, they're vested in terms of a 401k type, or their own personal?
No, pension, yeah.
Just
Pension,
pension. Do they vest in 5 years, or?
Is it 5? That was just for police? I don't know.
That's the category we saw this morning, earlier.
Yeah, I think it is, yeah.
I know that it was 5 for the, defined contribution. I think it is 5 for the, I'm not sure, but I think it is 5 for defined benefit.
Okay. Typically 5 years
Yeah.
vesting for most plans.
Yeah.
And then just go to slide 9 for the retirements. We talked a lot about this last month, the number of police retirements we saw over this 4-year period. Compared to what we expected, it was double. And most of them are under 55.
Yeah.
They're getting out as soon as they're eligible. In the city. And the fire, we had 4 under 55. And remember, I said, we didn't have any assumptions that anybody could leave before 55. So we had almost half of the people left before 55 as firefighters, and
But the police can leave before, the under 55 could be like under 50.
Yeah,
Yeah,
I
I
just
mean,
put under 55,
You're
but
right,
yeah.
because I
Actually,
know there was one recently, there was a 48.
yeah, there was the firemen, the 4 firemen, one was 48, one was 49, one was 53, and one was 54. So 48 retiring as a fireman, that's pretty nice. So those comes with costs, so we just wanna kind of make better assumptions to kind of control that cost. And to, not think, so, I'm sorry, go ahead.
No, go ahead. Yeah.
So I was just gonna get to the end, is just our recommendations. Oh, and you wanted to see the splits, so.
I was, because of the conversation we had before.
Yeah.
Regarding, people who have delayed pensions, basically. Is that, no, well, like this one pension, I don't know if you were here, where the gentleman has retired a long time ago.
20 years.
Sorry, he left the city,
Yeah, he left the
but he
city
was invested,
and he's
vested
vested.
in the plan.
Do you have anything about that as far as an actuarial? I mean, if there's 100 people or 50 people or 200 people that are, is that a category?
Yeah, if they've left vested, they're in our evaluation report.
Okay,
Yeah, they're in our evaluation report with an assumption that they're going to retire at, most times we use 62.
okay.
Age 62, that they're gonna come on average. Some come earlier, some come at 65.
Would you have that roughly a number of those?
Oh, yeah, it's in our evaluation reports. We'll have that next month for you.
Okay.
Yeah. So our recommendations just on slide 11, again, I don't know who is this going to. But it was our recommendation for retirement to bolster up the police and the fire assumptions to kind of match, not go all the way up to that experience, but to kind of better get closer to what we just saw. Termination was to go to a service-based. Disability, we just tweaked the police plan. There were 7 disabilities in the last 4 years for police. We expected 2. We expected like 1 every 2 years. So we just bolstered that up. There were 5 disabilities under the age of 45 for police. Again, another, big, we don't have an assumption anywhere close to that. So then on the last 4 slides, 12, 13, 14, 15, is just a breakdown of each change by plan. So this is the city's plan. So we're recommending a change to the mortality, and you can see under the UAAL change, it's the unfunded liability. There was a savings for the city plan for mortality, retirement, and termination. All 3 that we made adjustments for had a positive impact on the liability for all 3 of these on the pension, on the city's plan. So the funded ratio went from 77.8 to 79.1, and the contribution went down as well. So our changes that we're recommending for the city all have a positive impact. Next slide is the food services group, or one back, yeah. Again, that had positive impact as well for all 3 changes. City and food of services are very comparable. Go to police. Police plan, you'll see the mortality change had a positive impact on the liability, but then the retirement change had a significant increase. And that's what we're saying is,
I'm a little confused.
Yeah.
Only because in the past, like life expectancy in Connecticut, I think we're like 5th, 4th or 5th, somewhere in there.
your top 5 for sure.
Top
Yeah.
5, and prior, they were using an average.
National average, yeah.
The national average. So that means that if we go to Connecticut from a national average,
Yeah.
that means the retirees are living longer. So wouldn't our liability increase because we'd be paying out on average pensions for a longer period of time?
They all moved to Florida.
What?
They all moved to Florida when they retired.
Yeah, but
They go to the villages for
Right,
everything.
but
That's
no,
where my parents are.
I'm just
No,
saying that.
you have a great point. So we use a standard table that's for the whole country. But what the actuaries do and what your previous actuary did when he set the assumptions is we then adjust that table to match Connecticut and Norwalk experience. So although it's a national table, it's been adjusted to match Connecticut experience, which is really good.
Right,
So we're just making further adjustments to go even further to say that they probably went too far.
oh, okay.
We're coming back a little bit, so we're saying, we're saying you're gonna, they went too far, on expectations of life expectancy.
Okay.
So again, the new table is based on public sector data. The other table they used was based on private sector and public sector data. So public sector's life expectancy isn't as good as the private sector.
Okay.
Wow. That you can get real,
That's surprising.
Sorry, just me.
well, you have a lot, police and fire plan, they don't have as good mortality as teachers, which you don't have any. They have the best mortality. But they're not in this, either, any of these plans. But anyway, so retirement, termination and disability for the police did have an increase here. And then for the fire, it's mostly the retirement change. Making that assumption that 48-year-olds could retire where we didn't have that assumption comes with a cost.
Okay.
So,
Right.
I don't know who votes on that, but.
We can refer everything to that.
I'll talk to Jared afterwards.
You will come, yeah.
All right, thanks, guys.
Thank you.
Thank you.
Favorite topic, Frank, coming up.
You know, I actually made a mistake and called my wife Chitsamay once only because she wanted more.
More money.
She likes a lot of money too. All right. Okay. We're gonna start raising cash.
That's just 9 million. That's all we're asking
That's all.
for.
How long does that take you to the
To
fiscal
the
year?
end of the fiscal year.
And then we'll get
Contribution coming in
contribution coming in
July.
July, so we
Mhm.
won't need, after the 9 million, we might not need money till say September.
Correct.
Okay.
So we put together a recommendation, again, it's, we're overweight to US equity, given the run up, even despite
The last 2 weeks.
the last 6 weeks, they're still overweight to US equity. That being said, I know after last week's meeting, fixed income has actually done reasonably well year to date. Through yesterday, the ag is up 2.3% versus, a US equity market down between 5 and 7%. So, the fixed income allocation is probably higher than what we're showing in the spreadsheet. But just given the overweight to US equity, we would recommend raising cash flow.
Anybody have any discussion or want to make any changes to this? So we take the 9 million out of,
I move that
Equity.
we sell $9 million worth of BlackRock Russell 1000 index and move it into cash to meet our cash needs for the rest of the fiscal year.
I'll second that.
any discussion? All in favor?
Aye.
Opposed? Nope. Excellent. Performance?
Do we have performance? We did put together some fixed income materials, given the time. It might be best to have that discussion where we can allocate it, an hour to walk through both the treasury sample funds that we put together as well as our higher conviction core plus managers, if that's reasonable for everyone.
All right.
So that's on tab
3 and
3 and
4.
3 and 4 of the
Yeah.
full package. Okay,
Yeah.
thanks.
So the tab 3 is simply sample shorter duration treasury funds from Vanguard. It was not a search. This is not something that, we did a search for. It was just to kind of show you the experience if there was a desire to shorten the duration within fixed income and have a treasury bucket for liquidity. We certainly have clients that do that. Tab 4 are for high conviction managers. We did do a search process for this. There's a lot of detail in there that, I think ideally we'd like to spend and allocate some time to walk everyone through the candidates. But I'm not sure tonight at this point is the right.
Yeah, we're already 8:30. And I mean, I'm gonna hear grumbling because they go, well.
Well, I think it's better to have a thoughtful discussion on it than try to rush the topic.
Yeah, I agree.
That's okay. So I'll turn back to just inside the cover for the pension flat report. This is just through January. So markets were actually up in January, both equities and fixed income. The Fed held rates steady. US equities are up about 3%. large caps continue to outperform small, value outperform growth. Global X, US equities outperformed US up 4%. You know, and given all this, obviously the last 6 weeks have been a very different story. So, you know, in February, the S&P was down 1.3%. It's down 6.4% year to date or month to date through yesterday. We've seen value largely outperform growth. You know, I think the tech sector is particularly hurting. But the story abroad is a little rosier. We have seen international equities outperform, as well as emerging markets outperform, and in particular, China has rebounded significantly. So I think take these January numbers with a grain of salt. At the end of January, total assets about 549 million, consistent with past quarters, the overweight to US equity, underweight to fixed income. We did see some more distributions within private equity, not big, but the 2014 fund continues to make distributions. And then on the next 2 pages, we have returns, you know, largely strong on an absolute basis within US equity, LSV, trailing the benchmark still, but continues to perform well over long periods. Principal has rebounded. I would note that year to date, they are trailing their benchmark, which we'll see in February and March. To Walter Scott's presentation, I think, you know, if you look at international equity returns over the past 12 months, up 11.5%. You know, that's a typical environment that they are not going to perform well in. Silchester has also struggled a little bit to keep up with their value index. It's been very concentrated in terms of region and sector that have outperformed broadly.
Yeah, but Walter Scott, the number that they gave was so different. I didn't quite understand. We were seeing, it was a 2.71% for last 12 months. And she was talking 8% over, basically, it sounded like 16 months, I guess it was, or 18 months.
During the 1 year.
8% was the
Since
compounded
inception.
since inception.
Since we've invested.
Correct.
Which would be, I guess, between 12 and 36
Yes.
months.
Yeah, yeah.
Exactly.
Yeah.
We don't have it and we can't do
Right.
to the day.
Right, I'm sure
return
you're right.
metric,
Okay.
So ours are gonna be slightly different. BlackRock, you know, they've been overweight to tech, and underweight to China, which as I mentioned, strongly outperformed, which has hindered their ability to keep up with the emerging markets index.
Not way off, though.
And, you know, I would point out ABS as a manager we want to have in again this year, based on conversations from a couple of years ago. They've done really well, on an absolute and relative basis. You can
Yeah.
see up 16.5% for the trailing year. And then on the following page, you know, not a lot of change with your fixed income. Largely tracking the ag index, while UBS and PIMCO have done a nice job
Definitely.
outperforming.
Are there any ETFs for any of these MSCI index? I mean, is there an ETF for the say,
MSCI.
They're passive vehicles.
Yeah.
I mean, would we be better off? I mean, it seems like everybody's consistently underperformed. For
So
the
I
most part.
I think one of the interesting parts is, you know, your 2 managers, Silchester and Walter Scott, both have a significant quality and valuation component to their process, and that tends to be rewarded in down markets. So I think as we, you know, international equity markets have largely not performed as well as the US, but it's been a bull market for them over the past few years too. You know, I think it's gonna be tough for them to keep up in that type of environment, but over the long term, you know, they should outperform in a down market. But at the same time, we do have clients that have gone passive and decided, you know, we'll buy the market and
I think the research, long-term research would support the idea that from a capital market perspective, that international markets are still inefficient enough where there's alpha to be had. As compared to, say, the US, there's less there.
That's helping.
Yeah, so it's still,
Yeah, we would
would
argue.
suggest active, even though the shorter term has been, it's been difficult.
And that's really what's driving the total fund relative underperformance. You know, it's that active management and international. Because largely the rest of the managers have done a nice job.
Do you want anybody coming in next month?
So next month we have Empower lined up to come in because we have a DC meeting. If that's okay, we can have.
Yeah.
Okay.
You also try to squeeze it out, that meeting in. Be pretty quick.
Sure. Do you want to discuss the fixed income?
Yeah.
Next month?
Yeah, next month, we're gonna,
Okay.
so we're gonna power in and fixed income.
Perfect.
Yeah.
Great.
Good discussion.
Anybody else, any other?
Results. If you want to do that too. You want to do that evaluation? We'll have the evaluation.
I think it's probably too much.
Yeah.
So maybe in May.
Yeah.
That's okay.
That's fine.
Does anybody have any other questions? Any other motions?
I moved to adjourn.
Richard was quick there.
I'm just trying to, you know,
All in
you're,
favor?
Keep us moving here.
Get us out of here by
you're
8:30.
31 minutes over. I don't know how that bothers you.
All in favor, aye.
Make sure you
Opposed,
leave.
no.
I will. I'm gonna tell Joe this, okay?